Welcome to Mastering MHA MBA. In this chapter, we begin building the language of managerial accounting, the language of costs. Every organization runs on resources, and every decision about those resources depends on understanding what things cost, why they cost that much, and how those costs behave. Chapter 2 helps us answer these questions. Let's dive in and explore how accountants and managers classify costs to support planning, control, and performance evaluation. Section 1: Costs and cost terminology. At the core of managerial accounting is the idea of a cost object, anything for which we want to measure costs. It could be a product, a service, a project, a department, or even an entire organization. We distinguish between actual costs, which represent what was really spent, and budgeted costs, which reflect the planned amounts. Comparing these two is how managers control performance. When assigning costs to objects, we use two main approaches. The first is cost tracing, used for direct costs, expenses that can be clearly linked to one specific object. The second is cost allocation, used for indirect costs that support multiple activities and must be distributed rationally. For example, in a hospital, the cost of a pacemaker for a cardiac patient is a direct cost, but the salary of the administrative staff is an indirect cost shared across many patients. The classification of a cost as direct or indirect depends on three factors: materiality, its size and importance; available technology, our ability to trace it accurately; and the way operations are designed. Section 2: Cost behavior patterns. Next, let's see how costs behave. Variable costs change in total as activity changes. More patients mean more medical supplies. Fixed costs remain constant in total within a certain time frame, like your monthly facility lease, which does not change whether you treat 10 patients or 100. The link between activity and cost is driven by what we call a cost driver, a factor that causes a change in costs. For example, machine hours drive maintenance costs and patient visits drive nursing labor costs. These relationships hold true only within a certain band called the relevant range, the level of activity where the cost behavior pattern remains valid. Outside that range, fixed costs might step up or variable rates might change. It's important to remember that direct and indirect costs can also be variable or fixed. For instance, medical supplies are direct and variable, while a supervisor's salary is indirect and fixed. Understanding these patterns lets managers forecast expenses accurately and plan for different scenarios. Section 3: Total costs and unit costs. Managers often analyze costs per unit to support pricing and efficiency decisions. A unit cost is the total cost divided by the number of units produced or services provided. But be careful, averages can mislead. If you double production, fixed costs spread over more units and unit cost falls, but total cost may not change. So never assume that a lower unit cost means you're more efficient without examining the full picture. Section 4: Business sectors and types of costs. Managerial accounting applies to all business sectors: manufacturing, which creates tangible products; merchandising, which purchases and resells goods; and service, which provides intangible value like consulting or healthcare. Manufacturing companies have three types of inventory. First is direct materials, the raw inputs. Second is work in process, goods being produced. And third is finished goods, ready for sale. Production costs fall into three categories: direct materials, direct labor, and indirect manufacturing costs, also called manufacturing overhead. Inventoriable costs are initially recorded as assets on the balance sheet until the goods are sold. Once sold, they become cost of goods sold on the income statement. In contrast, period costs, like administration and marketing, are expensed immediately when incurred. We also use two summary terms: prime costs equals direct materials and direct labor; conversion costs equals direct labor and manufacturing overhead. Prime costs reflect resources that directly make the product, while conversion costs show what's needed to turn raw materials into finished goods. Section 5: Measuring costs requires judgment. Measuring costs is not always straightforward. Managers exercise judgment in how they define and classify costs depending on their purpose. For instance, when analyzing labor costs, we must separate normal working time from overtime premium and idle time. These help identify inefficiencies and improve scheduling. the meaning of a product cost can also differ. For pricing decisions, it might include marketing and distribution. For government contracts, it must follow strict rules, and for financial statements, it follows GAAP definitions. So, cost measurement always requires context and clarity. The benefit of defining these terms carefully is that everyone, from the CFO to the line manager, is speaking the same financial language. Section 6, a framework for cost accounting and management. Cost accounting serves three core purposes. First, it calculates the cost of products, services, and other cost objects to measure profitability. Second, it analyzes relevant information to support decisions like outsourcing or pricing. And third, it provides data for planning and performance evaluation so managers can control operations and motivate employees. Two approaches to costing are commonly used. Absorption costing, which includes all manufacturing costs in inventory and can inflate income when inventories build up, and variable costing, which treats fixed overhead as a period expense to avoid that distortion. Understanding both is essential for evaluating performance fairly. Key takeaways: cost information is the foundation of good management. It helps leaders plan realistically, control effectively, and evaluate performance objectively. By understanding how costs are classified and behave, managers can make decisions that improve efficiency without sacrificing quality or innovation. Remember, managerial accounting is not about recording numbers, it's about interpreting them to guide strategy and motivate performance. This educational content is based on Managerial Accounting, Making Decisions and Motivating Performance by Datar and Rajan, 2014, Pearson. All rights to the original text belong to the authors and publisher. Thank you for watching Mastering MHA MBA. Join us next for Chapter 3 Job Costing.